Understanding private companies, structure, types, and implications. What is a private company? A private company is a business entity that is not publicly traded and is held under private ownership. Unlike public companies that issue stock to the public through an initial public offering, IPO, and have their shares traded on public exchanges, private companies typically do not engage in these practices. Their shares are not available for purchase on stock markets, making them non-compliant with the Securities and Exchange Commission's, SEC, stringent reporting and filing requirements. Key takeaways. Private ownership. Private companies are owned by individuals, families, or other corporate entities. Stock ownership. While they may issue stock and have shareholders, the shares do not trade publicly. Limited transparency. These companies are not required to disclose their financial status or operations publicly. Less liquid shares. Shares of private companies are generally less liquid, making it harder to determine their market value. How private companies operate. Private companies are sometimes referred to as privately held companies, encompassing a wide variety of business models. This includes everything from local mom-and-pop shops to larger, revenue-generating entities like Cargill and Koch Industries, both of which rank among the largest private companies in the United States. Challenges of remaining private. Remaining a private entity can present challenges, particularly when it comes to raising capital. Although private firms can access bank loans and equity funding, they often find it challenging to raise large amounts of capital when compared to public companies that can issue shares or bonds. Types of private companies. 1. Sole proprietorships. A sole proprietorship represents the simplest business structure, owned and run by one individual. This structure offers total control to the owner but exposes them to unlimited personal liability. Profits and losses are reported on the owner's personal tax return. 2. Partnerships. In partnerships, two or more individuals share ownership. While partnerships provide a collaborative model for decision-making, they also embody the aspect of unlimited liability akin to sole proprietorships. Profits are typically passed through to partners, who report their share on personal tax returns. 3. Limited liability companies, LLC. An LLC merges elements of both partnerships and corporations. Owners, members, enjoy limited liability protection like that of a corporation while benefiting from pass-through taxation. This structure helps shield personal assets from business liabilities. Regulations governing LLCs can vary significantly between states. 4. S corporations. S corporations allow up to 100 shareholders, providing the benefit of being tax-exempt at the corporate level. Instead, income and losses are reported on the shareholders' individual tax returns. This structure is particularly beneficial for small businesses that wish to avoid double taxation. 5. C corporations. C corporations can have unlimited shareholders and are subject to double taxation, once at the corporate level and again when dividends are distributed to shareholders. However, they can retain earnings for reinvestment, allowing for growth. Advantages and disadvantages of private companies. Advantages. Cost savings. Private companies avoid the high costs associated with an IPO and ongoing compliance expenses. Regulatory flexibility. They can operate with fewer regulations and less public scrutiny, allowing for greater agility. Control. Owners retain more control over operations and strategic direction, making it suitable for family-owned businesses. For example, Koch Industries has remained in the Koch family since its establishment in 1940. Disadvantages. Capital limitations. Raising significant capital is harder for private businesses, limiting growth opportunities. Financial liability. Owners can face personal financial risk if the company encounters debt or insolvency. Potential conflicts. In partnerships and LLCs, differing opinions among owners can lead to conflicts and operational challenges. Private versus public companies. The distinction between private and public companies extends beyond ownership structures and regulatory requirements. Public companies must adhere to rigorous financial disclosure requirements, filing regular reports with the SEC that include quarterly performance, annual financial statements, and details on major business changes. This transparency serves to protect investors but also holds public companies to higher accountability. In contrast, the private company's ability to keep financial information confidential means that it can operate without providing as much data to stakeholders and the public. However, this lack of transparency may deter potential investors who prefer the safety of full disclosure. Conclusion. In summary, private companies play a significant role in the economy, ranging from small, family-run businesses to large corporations with substantial revenues. While they enjoy certain advantages like control and reduced regulatory burdens, they also face unique challenges, particularly regarding capital-raising efforts. Understanding the intricacies of private companies is crucial for anyone looking to navigate the business landscape, whether as an entrepreneur, investor, or consumer.